Hello everyone and welcome to the channel of Wall Street Mojo. Watch the video till the end, and also if you are new to this channel then you can subscribe us by clicking the bell icon. Friends, today we are going to discuss a topic that is debt versus equity. Now we are going to go in detail regarding what is debt and what is equity and some of the key differences that are involved in debt versus equity. So debt and equity are the external sources of finance for any business. So when a business needs a lot of money for an expansion of project or for reinvestment and improving their products, services or deliverables, they go for equity and debt. So equity is basically helpful for those who would like to go public and sell their shares of the company to individuals. To conduct an IPO, a company needs to bear a various cost, but the end result in most of the cases are helpful. Now in case of debt, the story is slightly different. Businesses opt for debt of two main reasons. Firstly, if the business has gone through the route of equity, then they would take a portion of the debt to create a leverage. Secondly, many businesses don't want to go through the complicated process of IPO. That's why they opt for a route to take debt from the banks or financial institutions. In this tutorial, we'll look at debt and equity separately and then do a comparative analysis between them. Without any ado, let's get started. So here we are going to do infographics of debt versus equity, and let's start. See, there are many differences between debt and equity, but both serve the same purpose, that is to help the company to expand on their growth and endeavors. Here are the most important differences between debt and equity, which are as follow. Now let's understand debt versus equity. As you can see in this particular screen, we are going to discuss a couple of things, that is debt. We have already discussed what is exactly all about, equity what is all about. Now we are going to get into nitty-gritties of the differences. So as you can see, debt is used as a loan and the creditors can also claim the loan amount plus the interest. So basically debt is a kind of a thing where the principal amount is involved, the interest is involved. So a regular EMIs, that is equalized annual payments, have to be made to the lender every month or in some cases it's every year. So it depends upon the repayment schedules. Equity is a sharing the ownership of the company with the individual, which allows them to receive dividends and voting rights. So equity shareholders, they aren't bound to get the dividends. So it's not compulsory on the company to pay dividends to the shareholders every month or every year, but it is recommendable. But the thing is that it's not compulsory on the part of the company, and the dividends are received by the shareholders and based on their voting rights. The second difference is involvement. Much less, since there is no ownership sharing. Okay, there is no ownership sharing, there is only one party. Let's say if you're taking a debt of 100 crores, then that debt is taken from let's say 𝐃𝐞𝐿, or let's say you have taken from HDFC Bank. Then in that scenario, there's only one party which is involved, there is no ownership sharing is there. Here, the equity financing is all about sharing the ownership, because there are n number of shareholders which are involved and they get dividends, and based on those dividends, the sharing of the amount is involved. Now the third, cost of capital. So basically, if you see in terms of cost of capital, there is a fixed predetermined cost of capital which is known as cost of debt, which is also known as KD. So basically KD is cost of debt, which is the interest amount. I'll try and explain you what is KD and KE. So KD is cost of debt. Cost of debt is equal to the interest what you are going to pay, and this interest will be post-tax. So we'll be doing 1 minus tax in this. So once you deduct 1 minus tax, you close the bracket and you divide the whole thing by so-called as the amount of the total debt. So by doing that, we receive KD, which is known as cost of debt. Now let's see what is cost of equity, cost of capital in terms of equity. So the cost of capital over here is not fixed. Okay, over here it is fixed, because let's say the interest is been charged as 12% and the tax is, let's say, 30%. So 1 minus 30 is 0.6. So 12 into 0.7 divide by, let's say the total debt is 100 crores. So the amount comes down to 8.4 divided by 100. That is 8.4%. So 8% is the fixed level of interest rate that is going to flow for the number of months going forward. But when we talk about cost of capital in terms of equity, the cost of capital is not at all fixed. It keeps on fluctuating based on the share prices and PE ratios and so on and so forth. So basically the cost of capital in terms of equity is calculated based on the KPAM method, which is known as CAPM, which involves the KE is calculated by the help of CAPM method, which is also known as RF, that is risk-free rate, RM, that is risk from market, minus RF, that is again risk-free rate, into the beta. So as the beta changes, or as the risk of the market changes, or as the risk of the risk-free rate changes, automatically the cost of equity also changes. So there's a high level of fluctuation in terms of cost of equity. Now let's get into the fourth part, that is known as the voting rights. Creditors don't receive any sort of voting rights. They have the direct ownership on the debt. But when we talk about the equity holders, they receive the voting rights, because based on those voting rights on the shares, they are able to give equal rights. And based on those equal rights, the shareholders is the whole key concept in terms of company. Now dividends. No dividend is been paid in terms of debt because they receive interest. But in case of equity shares, dividend is paid whenever the company decides to. So it's not compulsory on the part of the company to pay dividend, but if the company is paying, then if the company is willing to pay, then it will pay dividend to the shareholders. So over here interest is paid, over here the dividend is paid. Let's go to the sixth difference. Does company share profits? Over here, no, not at all. No. And over here, yes, through the way of dividends. Over here, why no? Because you get interest every time. There's no profits. So even if you earn profits, let's say you have taken a debt of 100 crore and you are paying interest, let's say at the 8% that we have calculated, which is known as the cost of debt. Now, if you are earning, let's say you have invested that 100 crore in, let's say in your business of biodiesel, let's say, and you earn close enough to 250 crores. So that 150 crore is your profit. So you are not going to get, or the bank is not going to get any portion of that profit. But if in the same scenario, if the company is earning, let's say that 150 crore, then it can distribute that profit to the shareholders among all the shareholders with the means of dividends when the creditors' equity holders are paid. So irrespective of earning profits or incurring losses, debt holders needs to be paid. So as simple as that, there is a fixed payment that needs to be done at a regular interval of time. So even if you make profits, you make losses, banks doesn't have to do anything with this. The debt holders doesn't have to do anything with this. They needs to be paid whatever the regular interest that is to be paid. That is the EMI. Unless the company makes profits, the equity shareholders don't get paid. It's as simple as that. If the company is not making profits, it's not going to pay dividends. So over here, there is a quite of a fluctuation. And over here, the things are steady in nature. Time of payment. It is paid first. Paid first means at the beginning of the month, the amount has been paid. That is the principal amount and the interest amount. But over here, the dividends are paid at last. That is, let's say for the whole year, the company has done the business. So at the end of the financial year, let's say after 31st March of 2018. So after that, if the company is earning profits, then they will pay dividends. And they will pay dividend close enough to in the neighborhood of the annual general meeting whenever it is going to get held. So the time of the payment is over here. It is like, as simple as that. This is a prepaid concept and this is a postpaid concept. Now, the level of leverage that is involved. Over here, it creates a leverage. Over here, it does not create any leverage. Why over here leverage is there? Because you are bound to pay. There is no discretion on the part of the consumer who has taken the loan that, if he's not in a condition to pay, then he won't pay. No, it's not that way. He has to pay. The leverage has been taken. So there is a debt burden on the part of the consumer or the company who has taken such loan from the bank or the financial institution. But over here, when we talk about leverage, they don't create any leverage because company is not bound to pay dividend. Only if it earns profit, then it is likely to pay dividend. Even the equity shareholders are the only last one to get their share at the time of the liquidation. So if the company is not in a condition to repay its debt or repay its money, then the debt holders are the first one to get their money, but the equity shareholders are the last ones to get their money. So there's no leverage on the part of the company. Now, this were the 9 differences that we had to study. Now let's get into some other details regarding debt versus equity and see what all things are involved. Now there are many differences between the debt and equity. They are very much visible. Debt is called cheap source of financing since it saves on taxes. Equity is called the convenient method of financing for business that don't have collateral. So the debt holder receive a predetermined interest rate along with the principal amount. Equity shareholder receive a dividend on the profits of the company they make, but it's not mandatory. So debt holders aren't given any ownership of the company. However, equity shareholders are given the ownership of the company. Irrespective of the profits or loss, the company must pay the debt holders. However, equity holders only receive dividends when the company generates some profits. Debt holders do not have any voting rights. Equity shareholders have voting rights for making the significant decisions in the business. So this is the complete way of determining what is the major key difference in terms of debt and equity. Now let's see some comparison. What is the meaning of debt? Debt is used as a loan and the creditors can claim the loan amount plus the interest. What is equity? Equity is the sharing of the ownership of the company with individual, which allows them to receive dividends and voting rights. Now the second point of discussion, involvement. So the first one that we discussed was meaning. That was the first one that we discussed. The second point that I want to ponder upon is involvement. So if we talk about involvement, in terms of debt, there is much less since there is no ownership sharing. But when we talk about equity, more, because equity financing is all about sharing ownership. If we talk about the cost of capital, the next is cost of capital. Then there's a fixed predetermined capital, but in terms of equity, the cost of capital is not fixed. If we talk about the voting rights, then in terms of voting right, the creditors don't receive any voting rights. Equity holders receives voting rights. Dividend over here, no dividend has been paid in terms of equity, in terms of debt, but dividend is paid whenever the company decides to, in case of equity. The seventh point of difference is when does the company share profit? Does the company shares profits? Okay, so in terms of debt, no. In terms of equity, yes, through dividends. Now, eighth point basically is when the creditors and equity holders are paid. Is the next question. When is the creditors or equity holders are paid? Equity holders are paid. One single question. So over here it has been paid in terms of debt, it is paid first, but in terms of equity it is paid last. Now the final and the final most point of discussion is leverage. The leverage was it creates a leverage and it does not create a leverage. So based on this, we can make a conclusion that we have seen all the major differences between debt and equity. Both are important for business. Thus, talking about which is more valid is redundant. We should rather talk about in which proportion a business can use equity and debt. Depending on the industry and the capital intensiveness of that industry, the business needs to decide how much new shares they will issue for equity financing and how much secured and unsecured loan they would borrow from the banks. Striking a balance between the debt and equity is not always possible, but the business should make sure that they can take advantage of the leverage and at the same time not paying too much in cost of capital. So that's it for this particular topic. If you have learned and enjoyed watching this video, please like and comment on this video and subscribe to our channel for the latest updates. Thank you everyone. Cheers.